Hey guys, what's going on? Welcome back to Stocks with Surfing. Today, we're talking about a company that just reported a record-breaking earnings, yet the stock is currently sitting at an 8-month low. That company would be Microsoft. So as you can see, it recently traded down about 11%. One of the worst days it's had since the 2020 pandemic. But when you look at the actual data, there's a massive disconnect between the headlines and the business. Is the AI bubble bursting, or is the market handing us the best entry point for a world-class compounder in years? Let's take a look at it. First, let's talk a little bit about why the stock is trading down. So the stock tanked because the math is starting to look a little scary. Microsoft spent $37.5 billion on AI infrastructure this quarter. That's a 66% jump in spending, only to support 17% revenue growth. At the same time, Azure, their cloud platform, grew 39%. But in a market price for perfection, great might not be good enough. The biggest red flag, we now know 45% of Microsoft's future business is tied strictly to OpenAI. Investors are finally waking up to the risk of having half your growth tied to one unprofitable startup. It's a massive valuation reset, but the patient investors, we might finally be seeing what looks like a good price for Microsoft again. All right, so let's do a little overview of this earnings report that caused Microsoft to drop 11%. So let's start with total revenue. Microsoft reported $8.3 billion, or a 17% year-over-year increase, which is phenomenal. Microsoft is currently operating at a $325 billion annual revenue run rate. To grow a company of this size at 17%, that's statistically insane. Most companies know this big are lucky to grow at 5%. This proves that the core demand for software and cloud doesn't seem to just be stable, it seems to be accelerating. Now, let's take a look at the massive backlog that Microsoft has. It's sitting at $625 billion, up 110% year over year. Now, this is the part that makes me a bit nervous, the quality of the revenue. Microsoft reported a massive $625 billion backlog, but $281 billion of that, nearly 45%, is tied directly to OpenAI. If we look at this rationally, we have to talk about circular financing. Microsoft invested over $13 billion into OpenAI, much of it in the form of Azure credits. When OpenAI uses those credits to run their models, Microsoft records that as Azure revenue. Essentially, Microsoft is giving OpenAI the money to buy Microsoft's own product. It's a closed loop. While the headlines see 39% Azure growth, I'm looking at it and wondering how much of this is real cash flow from external customers, and how much is Microsoft just moving money from its left pocket to its right pocket. OpenAI is projected to lose $14 billion this year. They aren't self-sustaining yet. As a rational investor, I'm keeping a very close eye on this, because if OpenAI's funding dries up, that 45% of Microsoft's backlog could turn into vapor overnight. Now let's take a look at the non-OpenAI growth, because even without OpenAI, it's still incredibly impressive. Microsoft's enterprise business grew at 28%. Think about that. Even without their biggest partner, Microsoft is still outgrowing almost every other legacy software company on the planet. The core business is a beast that doesn't necessarily need OpenAI to thrive. So the last notable thing I want to talk about for Microsoft's earnings is their absolutely insane CapEx growth. As you can see, it's growing at 66% year over year, which is very, very fast, or it's $37.5 billion now, which is very, very high. People are seeing this as sort of as a cost problem, and I tend to agree. When the revenue only went up 17%, and I don't say only as in that's low, but in proportion to their CapEx, it seems kind of low. And if you're Microsoft and a Microsoft investor, you really need this to end well for them. You need them to come out with an AI product that catches the attention of people and that people really want to use. But to understand why these numbers matter, you have to understand the machine behind them. I like to break Microsoft down into three simple empires: the factory, the office, and the living room. Let's look at how they actually make money. So to start, we have the factory. The factory is the heart of the company, and ironically, the reason for the 11% stock drop. This is Azure. Think of it as the electricity for the modern internet. When you use the ChatGPT, you aren't just using an app, you're renting space in the Microsoft factory. They make money through usage fees. The more AI people use, the more data flows, and the more Microsoft gets paid. It's their fastest growing engine at 29%, but is becoming incredibly expensive to maintain. They are spending billions to keep the lights on in the factory before the big checks start clearing. Next up, we have the office, the productivity and business processes. This is the sticky side of the business. Once a company moves into this building, they almost never move out. This is Microsoft Word, Excel, Teams, and LinkedIn. This is also the new home of Copilot. Microsoft is essentially acting as a digital landlord, charging companies a steady, predictable rent check every month. Now they're adding an AI tax, charging an extra $20 to $30 a month just to have an AI write your emails for you. This is the safety net. Even if the AI hype cools off, every company on earth is still going to pay their monthly Excel bill. It's pure high margin subscription gold. Next up, we have the living room. This is the legacy part of the empire, and right now it's the weakest link in the chain. This is where you're talking about things like Windows licenses, Surface laptops, and yes, Xboxes. Historically, this was how Microsoft entered our homes, but the data is clear. The living room is gathering dust. This segment declined by 3% this quarter. Why? Because Xbox hardware revenue crashed 32%. People simply are just not buying Microsoft Surface laptops and Xboxes like they used to. With Xbox, this is pretty clear. Microsoft, I don't think they want to be in the console game anymore. They want all their gaming revenue to be through Microsoft Game Pass. But this doesn't seem to be picking up at a rate that's going to make it extremely profitable for Microsoft. Obviously, if they can do it, this is way higher margin than Xbox hardware itself. But I have my doubts that can really turn this thing profitable. And even if you look at Windows, I'm on a Windows computer right now. The Windows revenue growth is only like 1%. It is basically a non-factor. So if I'm Microsoft, I would look for some new way to be able to get into people's homes. So let's take a look at the revenue growth of our main three segments. Let's start here with Intelligent Cloud. This segment grew at 29%, but the headline number is Azure at 39% growth. On the surface, this is a signal you want to see. But as rational investors, we have to look at the cost of that growth. Microsoft just reported a 66% jump in CapEx. That is $37.5 billion spent in only 90 days. Think about the math. They're spending $2 on hardware today to hopefully make $1 in revenue later. And here's the kicker. They aren't limited by customers, they're limited by electricity. This literally cannot build data centers or plug in GPUs fast enough to meet the demand. It is the most powerful growth engine in tech, but right now it is the most expensive one to fuel. Next, let's look at productivity. And to do this, we have to look at Copilot. Microsoft finally gave us hard numbers. 15 million paid seats currently for Copilot. That sounds great until you realize they have over 450 million total commercial seats. That is only 3.3% adoption rate. Only 3 out of every 100 business users are actually paying that extra $30 a month. But they're spending billions to build the AI. 97% of their customers haven't bought into the upsell yet. It's the early days, but that gap is exactly why the market is feeling a little bit nervous. That CapEx mixed with only a 3% adoption rate is very scary to me. Next up is, the dying living room, and we talked about this. And right now, the hardware sales are simply falling much faster than the software is growing. And when you add in the fact that Windows sales only grew by 1%, you realize this segment is no longer a growth story. And to be honest, I don't even know if it's a cash cow at this point. It's down 3%. We're going to have to keep an extremely close eye on this moving forward as it's becoming unprofitable at this point. Now let's take a look at the valuation for Microsoft, starting out with the forward PE that is 25.9. So before this earnings drop, Microsoft is trading at a high of 34x earnings. At 25.9x, the market has seemed to officially reset them. We are no longer paying an extreme premium for AI promises. We're going to be paying a proper price for a company growing revenue at 17%. For context, this is the cheapest the stock has been relative to its future earnings in over 3 years. Next up, we got free cash flow. This is the most controversial number in the report. Free cash flow has fallen roughly 9% year over year because Microsoft is funneling every spare dollar into AI servers. They're spending a record $37.5 billion in a single quarter. It seems to be a classic short-term cash flow when I'm investing in companies, it's always important to me that my companies are handling their debt properly, either have low debt or they can pay it off relatively easily. So I'm always going to have a metric like interest coverage ratio in there, and that's the one that I chose for Microsoft. So if you're worried about debt like me, don't be. This ratio tells us how easily Microsoft pays the interest on its loans. A ratio of 2x is considered safe. Microsoft is at 53.6. They could pay their interest obligations 50 times over. Their balance sheet is quite literally a titanium fortress, allowing them to outspend almost anyone else in the AI race. So this does kind of, make it so you can, not be as scared about the CapEx, but remember, it's still important how much they're paying for future returns. Next up, we have operating margins. So despite the massive spending, Microsoft's operating margins are actually beat expectations, coming in at 47.1%. This is elite. It proves that even while they're building massive data centers, their software and cloud businesses are so efficient that they're keeping nearly 50 cents of every dollar as operating profit. And finally, we have the return on invested capital. I love this metric because it really tests how good your CEO and management teams are. And I'll tell you, Microsoft's is pretty darn good at their ROIC is 28%. It's generating a massive return on every dollar they put to work. They aren't just spending money, they're compounding it year after year. Now let's take a look at the bear cases for Microsoft because, I think there are a couple new ones coming out of this earnings report. So the first part of the bear case that comes to mind is Microsoft's CapEx grew 68%, but their revenue only grew 17%. In any other industry, if your spending outpaces your sales by 4x, your stock is going to get crushed. The market is starting to worry that Microsoft is an efficiency trap. They're building $37 billion worth of data centers every quarter, but the return on investment isn't showing up fast enough. With copilot adoption sitting at only 3.3%, the bears are asking a fair question: what if the demand for AI simply just never justifies the costs of building it? And I think that's a fair question to be asking at only 3.3% of adoption with Copilot. That's a serious problem. But remember, look at what happened with Meta. Meta was spending a ton on CapEx, and it saw significant revenue growth from the CapEx, and the stock was rewarded. So at the same time, there is definitely some upside here if Microsoft ends up to be doing the right thing and AI demand goes up. But there's also the whole problem with OpenAI. They're projected to lose $14 billion this year, and they're burning cash so fast, they're currently begging for $100 billion funding round just to keep the lights on. If OpenAI stumbles, whether it's through regulation, a failed 2026 IPO, or just running out of money, Microsoft is going to lose nearly half of its projected growth. We aren't just betting on Satya Nadella anymore. We're betting on Sam Altman's ability to turn a massive loss into a profit before the cash runs out. This is a single point of failure the rational investor simply cannot ignore. I think that's a super important point because what if OpenAI does IPO and people see their financials and they get scared? That's definitely going to hurt the entire market, but specifically Microsoft, since they are so tied at the hip. So let's try to value Microsoft. So let's start by looking at the forward PE of 25.9x. Well, this is significantly cheaper than the 5-year average of 33x. This means the market has stopped paying for AI hype and is really paying for reality. It's a bargain price, but only if the earnings can stay strong. Now for EV/EBITDA, the engine is still very efficient. This is the acquirer's multiple. At 18x, the core business engine is running smoothly. It ignores the non-cash accounting noise and shows that Microsoft is still one of the most profitable machines on the planet. For free cash flow yield, cash is simply being eaten by chips. This is a red flag. Usually you want this higher, closer to 3-4%, because they're spending $37 billion a quarter on AI hardware. There is less free cash left over for you. The stock is currently growth gamble. It's not a cash cow. But the PEG ratio says it's a little bit expensive. So a PEG of 1.0 is considered a steal, and 2.0 is expensive. At 1.5, you're paying exactly what growth is worth. You aren't getting a massive discount, but you aren't overpaying significantly either. But here's the most important thing to remember. Microsoft is a titan with or without OpenAI. Even if you stripped away the headlines, you're left with a company that owns the global standard for productivity, the second largest cloud engine on earth, and a fortress balance sheet with $12.7 billion returned to shareholders just this last quarter. The non-OpenAI part of their backlog is still growing at a healthy 28%, proving that their core business, LinkedIn, Office 365, and Dynamics, is an absolute cash machine. So here's my final take. Microsoft is currently caught in an AI arms race where the costs are certain, but the returns are still being debated. For me, I'm not going to chase the hype. I believe Microsoft is a fantastic business, but I'm waiting for the OpenAI concentration risk to be fully priced out of the stock. Once the market stops valuing this as a lottery ticket on Sam Altman and starts valuing it as the world's digital operating system again, that is when I'll be ready to back up the truck. Until then, I'm staying rational. I'm going to be watching the CapEx and waiting for my price. So that wraps up this video on Microsoft. I hope you guys enjoyed. If you're still here, that means a ton. Yo, hit that subscribe button, and I'll see you guys next time. Peace.